Ladies and gentlemen, let me ask you a dangerous question. What if the strongest looking part of the market is actually the weakest? What if the same 7 stocks holding up the entire financial skyline are quietly turning into the fault line beneath it? History doesn't whisper before it breaks things, it repeats itself loudly. And today, the so-called Magnificent Seven stand exactly where every overconfident empire has stood before the fall. For years, these giants carried the market on their shoulders. Trillions of dollars flowed into the same names, the same trades, the same stories. Too big to fail. This time is different. AI changes everything. But listen carefully, those words have always been spoken right before wealth evaporates. Concentration is not strength, concentration is fragility. When 7 stocks account for the majority of market gains, you're not looking at diversification. You're looking at a single point of failure. Here's the uncomfortable truth: valuations stopped reflecting reality a long time ago. Prices raced ahead while earnings lagged behind. Growth assumptions became fantasies and fantasies became market cap. When expectations rise faster than cash flows, gravity eventually shows up. And gravity doesn't negotiate. It corrects violently, suddenly, and without mercy. Think about what happens when liquidity tightens. When rates stay higher for longer. When margins compress. When growth slows by just a little. These stocks don't need to collapse completely to destroy trillions. They only need to disappoint. A 20% repricing here, a 30% multiple contraction there, and suddenly $7 trillion doesn't disappear in a crash. It bleeds out in plain sight while investors argue on television that it's healthy. And let's talk psychology, because markets don't break on data. They break on belief. The moment confidence cracks, everyone rushes for the same exit at the same time. Passive funds sell because they must. Algorithms sell because they're told to. Retail panics because prices fall. What was once unstoppable momentum turns into unstoppable downside. This is how bubbles don't pop, they unwind. But hear me clearly, this is not a message of fear. This is a message of preparation. Every major wealth transfer in history came from moments exactly like this, when the crowd was overexposed, overconfident, and underprepared. The collapse of leaders always creates opportunity for those who saw it coming. Capital doesn't vanish, it changes hands. Market concentration at this scale is not a sign of strength. It is a warning signal flashing in plain sight. When a small cluster of companies accounts for a disproportionate share of total market capitalization, index gains, and investor attention, the system becomes structurally fragile. Capital stops flowing based on broad economic productivity and instead piles into the same names, the same trades, and the same assumptions. History shows that markets built on narrow leadership are not resilient. They are balanced on a single axis. And when that axis shifts, the entire structure tilts at once. What makes this concentration especially dangerous is how deeply embedded it is within modern portfolio construction. Pension funds, sovereign wealth funds, retirement accounts, and ETFs are increasingly tied to capitalization, weighted indices. This means exposure is no longer a choice, it is automatic. Investors may believe they are diversified, but in reality, their performance is heavily dependent on the fate of a handful of mega-cap stocks. The illusion of safety disappears the moment those leaders begin to underperform, because diversification fails precisely when it is needed most. The real risk emerges when price declines begin to feed on themselves. A modest sell-off in a dominant stock does not stay isolated. As its market cap falls, index weightings adjust, triggering mechanical selling from passive vehicles. That selling pressures prices further, inviting algorithmic strategies to accelerate the move. What began as a rational reassessment quickly transforms into a self-reinforcing feedback loop. This is not panic-driven behavior, it is structural, programmed, and unavoidable within the current market architecture. The hook many investors miss is this: concentration doesn't unwind gradually. It breaks suddenly. Markets can tolerate overvaluation for long periods, but they do not tolerate imbalance forever. When leadership narrows too far, the margin for error disappears. Earnings don't need to collapse, and guidance doesn't need to implode. All it takes is disappointment. A slight deceleration in growth, a cautious outlook, or a marginal increase in uncertainty can be enough to expose how much risk has been compressed into too few names. The most dangerous phase is when confidence remains high even as cracks begin to form. That is when investors double down, reinforcing exposure just as risk peaks. By the time headlines acknowledge the problem, capital has already shifted. The lesson is brutal, but consistent markets dominated by a small elite do not correct politely. They reprice violently, redistributing losses across portfolios that believed they were protected. Valuation expansion becomes dangerous when it detaches from the engine that is supposed to justify it. In efficient markets, prices rise because future cash flows are expected to grow faster, stronger, and more reliably. In today's environment, prices have surged far ahead of that reality. Multiples have expanded not because earnings have exploded, but because expectations have. Investors are no longer paying for what companies are producing. They are paying for what they hope these companies might someday become. This is where the hook hides in plain sight. A stock does not need bad news to fall when it is priced for perfection. It only needs reality to arrive. When valuations are stretched, even excellent results can trigger sell-offs if they fail to exceed elevated forecasts. Growth that would have once been celebrated becomes not good enough. The higher the multiple, the smaller the margin for error, and the greater the downside sensitivity to even minor deviations in performance. Much of this valuation inflation has been fueled by narratives rather than cash flows. Themes like artificial intelligence, platform dominance, and infinite scalability have been translated directly into market capitalization without sufficient regard for timing, cost, or competition. Markets have pulled future success forward into today's prices, effectively borrowing returns from years that have not yet occurred. When that happens, the future must deliver flawlessly just to justify the present, let alone support further upside. Another layer of risk emerges when discount rates shift. Elevated interest rates increase the cost of capital and reduce the present value of long-duration earnings streams. Stocks trading at extreme multiples are mathematically vulnerable in this environment because their valuation depends heavily on profits far out in the future. A small adjustment in discount assumptions can erase years of perceived value in a matter of weeks, exposing how fragile those prices really are. The most overlooked danger is how quickly sentiment can reverse once valuation credibility is questioned. Investors may tolerate expensive markets, but they do not tolerate unjustifiable ones. When confidence in the growth story weakens, multiple contraction becomes swift and unforgiving. Prices don't drift down, they snap back to levels supported by tangible earnings power. What once looked like unstoppable momentum reveals itself as leverage disguised as optimism, and markets relearn a timeless lesson: valuation always matters, just not all at once. Interest rates are not just a background variable in markets, they are gravity. When rates rise and remain elevated, they quietly but relentlessly reshape how assets are valued, especially those whose worth is tied to distant future earnings. High growth mega cap stocks are effectively long duration assets, meaning a significant portion of their valuation depends on profits expected many years from now. When the cost of money increases, those future earnings are discounted more aggressively, and what once looked massive on paper suddenly looks fragile. Here's the hook: most investors underestimate markets don't need rates to go higher to feel pain. They only need rates to stay higher for longer. The assumption that monetary easing will always arrive just in time has become embedded in asset prices. When that assumption is delayed or challenged, repricing begins immediately. Stocks that thrived in a zero-rate world struggle in a reality where capital is no longer cheap and liquidity is no longer abundant. Tighter financial conditions affect more than valuation math. They influence behavior. Companies facing higher borrowing costs become more cautious with expansion, acquisitions, and hiring. Consumers feel pressure as credit tightens. Growth slows at the margin, and when growth slows, the premium investors are willing to pay for future earnings contracts. This is especially dangerous for companies priced on aggressive growth trajectories that leave no room for deceleration. Liquidity is the silent accelerant in this process. During periods of easy money, excess liquidity flows into risk assets, compressing volatility and inflating valuations. When liquidity is withdrawn, the reverse occurs. Bid depth thins, volatility rises, and price discovery becomes disorderly. The same liquidity that lifted markets on the way up becomes conspicuously absent on the way down. This is why declines during restrictive monetary regimes often feel faster and more chaotic than investors expect. Another overlooked risk lies in relative attractiveness. As yields on cash and fixed income instruments rise, the opportunity cost of holding richly valued equities increases. Investors no longer need to stretch for returns. Capital that once had no alternative suddenly has options, and that rotation does not require panic, it only requires logic. When risk, free or low, risk returns become competitive, speculative premiums evaporate. The most dangerous moment is when markets attempt to defy monetary reality. Confidence remains high, narratives stay intact, and prices resist gravity until they don't. Once investors collectively accept that rates will not rescue valuations, repricing becomes unavoidable. In that environment, optimism is no longer rewarded, leverage is exposed, and the market is forced to reconcile price with policy. The rise of passive investing has quietly transformed market behavior, not by changing investor intentions, but by hardwiring reactions into the system itself. Index funds and ETFs do not analyze balance sheets, question valuations, or reassess narratives. They buy and sell based on rules. When markets rise, capital flows in and reinforces leadership. When markets fall, those same rules reverse direction, forcing selling regardless of fundamentals. What appears calm and efficient on the way up becomes mechanically violent on the way down. Here's the hook most investors never see coming. Passive capital removes discretion at precisely the moment discretion matters most. As dominant stocks grow larger, their index weights increase, attracting even more passive inflows. This creates a momentum loop that feels stable until it isn't. Once prices begin to decline, that loop flips. Redemptions trigger automatic selling, index rebalancing reduces exposure, and the largest stocks experience the heaviest pressure simply because they are the largest. This is not fear-driven behavior. It is structural. A decline in a major index component forces selling across every vehicle that tracks it. Algorithms amplify the move by reacting to price momentum and volatility thresholds. Liquidity providers step back as uncertainty rises, widening spreads and accelerating price moves. What begins as a rational adjustment quickly cascades into a feedback loop where selling creates more selling, independent of new information. The danger intensifies when leadership is concentrated. When a handful of stocks dominate index performance, passive strategies unintentionally concentrate risk rather than disperse it. Investors believe they are diversified across hundreds of holdings, but their outcomes hinge on a small group of names. When those names weaken, losses spread simultaneously across retirement accounts, pension funds, and institutional portfolios, leaving few places to hide. The most deceptive phase occurs before the breakdown is obvious. Early declines are dismissed as healthy rotations or routine volatility. Passive flows continue, reinforcing complacency. But once drawdowns cross critical thresholds, behavior changes rapidly. Outflows accelerate, forced selling increases, and price discovery becomes disorderly. The same structure that once dampened volatility now magnifies it. What makes this dynamic especially powerful is its inevitability. Passive funds cannot pause, wait, or reassess. They respond instantly and proportionally. In markets dominated by passive capital, corrections do not unfold gradually, they cascade. When leadership falters, the system does not ask why, it simply executes. And in that moment, investors discover that the greatest risk was never the trade itself, but the structure that made everyone crowded into it at the same time. Earnings margins are the quiet foundation beneath every valuation, and when that foundation weakens, prices rarely stay elevated for long. Markets can forgive slowing revenue growth, and they can even tolerate temporary uncertainty, but they are far less forgiving when profitability begins to compress. Margins represent efficiency, pricing power, and operational discipline all at once. When those margins peak and begin to roll over, it signals that the easiest phase of growth is already behind the company. The hook investors often miss is that margin pressure does not arrive dramatically. It creeps in, input costs rise slightly, labor becomes more expensive. Competition intensifies at the edges. Regulatory compliance adds friction. None of these factors alone look alarming, but together they erode profitability quarter by quarter. Companies that were once able to expand margins effortlessly suddenly find themselves fighting just to defend them. For stocks priced as if margins will remain permanently elevated, this shift is dangerous. Mega cap leaders are especially vulnerable because their scale limits flexibility. As companies grow larger, sustaining exceptional margins becomes mathematically harder. Growth requires reaching new customers, entering less profitable markets, or competing more aggressively on price. At the same time, dominant firms attract regulatory scrutiny, political pressure, and public backlash, all of which increase costs and constrain strategic freedom. The market often underestimates how quickly these forces can weigh on earnings. Another overlooked risk lies in operating leverage. High-margin businesses benefit disproportionately during expansion, but the reverse is also true. When revenue growth slows even modestly, fixed costs consume a larger share of income. Margins compress faster than investors expect, and earnings forecasts must be revised downward. In markets where valuations assume flawless execution, these revisions can trigger swift repricing, even if absolute earnings remain strong. The psychology around margins is unforgiving. Investors anchor to peak profitability and treat it as a baseline rather than a high water mark. When results fall short of that peak, confidence erodes rapidly. Analysts adjust models. Forward guidance becomes cautious. Narratives shift from dominance to defensiveness. The stock does not need to become unprofitable to lose value. It only needs to lose the illusion of invincibility. What makes margin compression especially powerful is its compounding effect. Lower margins reduce cash flow, limiting reinvestment, buybacks, and strategic flexibility. That in turn weakens future growth prospects, creating a feedback loop that pressures valuation from multiple angles at once. In markets built on the assumption of permanent excellence, the realization that margins are cyclical is not just disappointing, it is destabilizing. Markets are ultimately governed by belief, and belief is far more fragile than balance sheets suggest. Prices move not only on earnings and interest rates, but on the collective confidence that tomorrow will look better than today. When that confidence is strong, investors rationalize risk, ignore warning signs, and pay premiums for certainty that does not truly exist. When it weakens, even solid fundamentals struggle to hold valuations together. This psychological shift is often the final trigger that turns vulnerability into decline. The hook lies in how abruptly narratives can collapse. For extended periods, dominant market stories feel unbreakable. Growth appears inevitable, leadership feels permanent, and every setback is reframed as temporary. Investors become conditioned to buy dips, reinforcing the belief that downside is limited. But narratives are not gradual in their demise. They persist long after evidence begins to fade, then fail all at once when perception flips. Once doubt enters the system, behavior changes faster than data. Analysts grow cautious in their language. Management tone shifts subtly. Media coverage moves from admiration to skepticism. None of these signals alone causes a sell-off, but together they reshape expectations. Markets do not wait for confirmation, they move ahead of it. By the time earnings reflect the slowdown, prices have already adjusted, leaving late reactions costly. The most dangerous phase is when investors realize they are no longer aligned with the crowd. Confidence breaks not because of catastrophic news, but because of isolation. When buyers hesitate and sellers feel urgency, liquidity thins. Volatility spikes. Small price moves trigger outsized emotional responses. This is when risk aversion replaces optimism as the dominant force, and capital preservation overtakes return maximization. Psychological breakdowns also expose leverage, financial and emotional. Leverage positions unwind rapidly when sentiment turns, forcing sales into falling markets. Long-term holders question their theses. Short-term traders exit en masse. What once felt like conviction is revealed as dependence on rising prices. The shift is not intellectual, it is instinctive. What makes this transition so powerful is its irreversibility in the short term. Once belief is damaged, it cannot be repaired by reassurances or optimistic forecasts. Trust must be rebuilt through time, consistency, and evidence. Until then, markets operate under a new regime, one defined by caution rather than enthusiasm. In that environment, valuations contract, leadership changes, and capital flows toward perceived safety. The collapse of narrative is not the end of the cycle. It is the moment the cycle asserts itself. So the real question is not if the Magnificent Seven will lose dominance, but who will be ready when they do. Will you be emotionally attached to yesterday's winners, or strategically positioned for tomorrow's reality? Will you follow narratives, or will you follow risk? Because markets don't reward comfort. They reward clarity, discipline, and courage. When $7 trillion is built on belief instead of fundamentals, the ending is already written. And those who understand that don't panic. When the collapse begins, they step forward. Stay alert. Stay disciplined. And remember this: the biggest opportunities are born the moment the crowd realizes the impossible has just happened.